equally as important, thank you everyone who's decided to attend. I'm pretty excited by this webinar. When Andrew and I were talking, I don't know, maybe a month ago about a webinar which is really meant to introduce the people on the program, people at today's event, to the way we think about investing in the Wall Street prep applied value investing certificate program, which Andrew just referenced. And uh, just out of the blue, I said that I wanted to do a talk on compounders, really for two reasons, maybe even three. But the big reason was is that I do think at the end of the day that long duration investing, that's why I call it long duration investing, meaning you're holding the stock for a while with the thought of that you would like to be able to hold it for as long as it makes sense. So it's not really a traditional value investment where you're buying at one price and you have a target price. And once you're done, you move on to the next trade. This is really the idea of you're going to own something for the duration, long duration. And when you think about Buffett, and Brett did a terrific webinar on using AI to recreate a Warren Buffett investment mind. Really clever idea. And I'm pretty sure the replay is available. Um, if you think about Buffett's style, he ideally likes to buy things for as long as he possibly can hold them. Much of an influence from Charlie Munger. Everybody talked about that, although that was like 50 years ago. So I think at this point you'd have to say they both kind of co-developed that. But if you were investing with the idea of holding on to the stock for a while, you're effectively buying a compounder of some type. And so part one is I wanted to do this webinar because I really wanted to flesh out some ideas I have around long duration investing. The second thing that really was even more of a motivator is that the phrase compounder gets used a lot, and yet there is no shared or accepted definition of what a compounder is. And that, for somebody like me, and some of you know me, that drives me crazy because it's like, how can you use a word as a descriptor, particularly a class of companies, or maybe you say a class of stocks representing the companies, is you use that word, a compounder, and yet no one can seem to define what that means. So the two I thought were very important. So what I'm going to try to do today is define a compounder, or more importantly, is I'll give you my definition of a compounder. And what I'm looking for is something that you can use. I often use a phrase that the definition is operational, meaning you can use it in your operations. And then I'm hoping that with that foundation, you realize that long duration investing is effectively investing in compounders, almost by definition. And so that's the goal of today's webinar. All right. So we say right here on the slide that a compounder is that rare company that compounds shareholder value over decades. And what, well, I'll get into it, but it's that definition is good but wrong. Now this is what Buffett said, which I really like. The best business to own is a company that generates high cash earnings on invested capital. I think most people know that. That is in position to reinvest the profits in the company, ideally at a return on capital similar to what they've done in the past, which works to compound the intrinsic value of the business over time. So everyone keeps coming back to this idea of growing the intrinsic value. There's a missing piece, and it's that missing piece I want to highlight today. All right, so as I said, compounds are a phrase that get used a lot. On Columbia, I'm an adjunct professor. I'm very quick to point out I'm not a full-time professor. Do not have a PhD. I am an adjunct professor at Columbia Business School, and I have been for over 30 years. And I have taught, I just finished last week with my 65th semester long course, been doing this for a while. This phrase, compounders, gets used a lot at Columbia. And I ask people, what do you mean by a compounder? And in a moment, I'll give you sort of how people respond, but I wanted to figure it out. And then, so I scoured the internet for a definition, and I did find 5 Wall Street reports that had compounders in their title. I thought that was fair. And the best quote I found in the reports is, there's no source of truth for what defines a compounder. And the fact that the report was published and they said that, I thought was crazy. I just thought, this is just crazy. How could you go around saying something's a compounder and yet there's no source of truth? And then almost all the reports said the same thing. A compounder is a company that can consistently grow its intrinsic value at a high rate for a long period of time. This is technically not true. We'll get there today, I promise we'll get here. So if I consolidated the reports that we saw on Wall Street, you see a lot of things come back: high return ratio, strong cash flow, uh, which, by the way, those two are somewhat redundant. Pricing power. I will push back and argue that it's price elasticity, not pricing power. Reinvestment, they can reinvest the cash flows, which then really is a different phenomenon. Durable assets, durable intangible assets. Again, I don't think it's necessary. Skilled management, I don't know what that means. Long time horizon. So we'll come back to it. I even asked ChatGPT and Gemini, which brought my total sources to 7. And this is what Gemini said: a compounder company consistently grows its value over time. Again, ill-defined. What does value mean? And some key qualities include strong franchise. Again, not defined what a franchise is. High cash flow generation relative to what? Low capital intensity. Okay. Minimal financial leverage. Again, I'm not sure that needs to be part of the definition. Allowing for sustainable long-term growth. Growth in what? Growth in what? So, this sounds great until you push on it and try to see, could we create a checklist, or could we create a descriptor or something? All right, so Gemini, just these were the phrases: strong franchise, high cash flow generation, low capital intensity, minimal financial leverage, high return on equity, and return on invested capital. But if you have minimal leverage, by the way, high return on equity and return on capital are the same thing, but why be a stickler? Sustainable competitive advantage. There's one that finally I agree with. Long-term growth rate. I agree with. I'm going to reframe it. Clear strategy and skilled management. We have to tighten that up. All right. And then finally, Gemini, focus on value creation. They prioritize long-term value creation for shareholders. I happen to agree with this one a lot. The problem is I will argue that very few managements and boards know what that means. Stable and growing earnings. This is redundant with prior bullets and high gross margin. Why does it have to have high gross margin? I don't know. Amazon doesn't have high gross margins, and they seem to be doing just fine. All right, so this is the lists, and the same list as before. I just consolidated. So the goal is sustain long-term growth and shareholder value. All right, consolidating the definition. All right, let me just go through this. High return on invested capital, ROIC greater than the cost of capital. Yes, absolutely agree with that. 2, competitive moat. I define this as a sustainable competitive advantage required if the ROIC is going to be maintained. So those two are kind of together. One is high return on invested capital, like I think current or historical. Competitive moat means in the future. That's the key. Sustainable competitive advantage. Low capital intensity and high free cash flow. Hard to see the print, but that's incremental return on ROIC is incremental return on invested capital minus your growth rate equals, that's your free cash flow. That looks like a minus. Sorry, didn't font. So it's the ROIC minus your growth rate is your incremental free cash flow. Consistent growth in revenue and NOPAT. I'd argue NOPAT's more important, but margins can only shift so much. So it says I like that. Long runway of reinvestment opportunities. Consistent growth requires reinvestment opportunities. So those are somewhat redundant. Minimal leverage. Consistent with low capital intensity and high free cash flow. The key is these companies don't need leverage. They don't need leverage. Management focus on creating long-term shareholder value. Critically important that management focuses on the long term. I agree with that. Still, we're left with a lot of words and no crisp definition. All right, so I want to go back to it. I'm going to start to narrow it down, if you will, winnow it down. High return on invested capital, absolutely. ROIC has got to be greater than the cost of capital. You're not going to create value for shareholders. That's for sure. Competitive moat, sustainable competitive advantage. I would argue that's critical. Absolutely. Long runway of reinvestment opportunities. Yes, a large total available market. TAM is total available market. I agree. Management focus on creating long-term shareholder value. That's the importance of management. So I think we're getting closer, but we still have to tighten it up a little bit. All right, I asked my best student to define a compounder. I'm just curious what he would say. So he said, reinvest capital at attractive rates of return. So ROIC and incremental ROIC for a long period of time. Now, I'm just telling you what he said. And so my response is the ability to sustain and redeploy earnings into new opportunities that continue to create value. That is, the ROIC is greater than the cost of capital. And in fact, what you want is your incremental ROIC to be greater than the cost of capital. Durable competitive advantage. Yes, sustainable competitive advantage, typically driven by both scale and customer captivity. I will flesh that out in a minute. Market skepticism that growth and competitive advantage will fade over time. The stock market underestimates this duration. That's the key. That's why these stocks go up over time. I'm going to tighten this up. Remember, this is the student response. By the way, I think you did a great job. As Otherwise, I wouldn't be including it in the present. As the business proves its ability to reinvest, investor expectations for growth tend to increase. It's really important, which is reflected in a higher portion of the value being attributed to growth, which I refer to as market implied value of growth. I will flesh that out to anybody who's new to that concept, and we talk a lot about that in the program. All right. Investor expectation for growth tend to increase. This observation is important. All right, the final comments. Investors often underestimate the power of compounding for these businesses, at least fairly early in their life. As these companies continue to reinvest at attractive rates, that's what I refer to as the incremental return on invested capital. Their earnings power value, that's VPV, will increase incrementally over time as long as the return on capital is greater than the cost of capital. And these continued reinvestments will drive immense long-term value creation. I agree with that. As a result, investors do not necessarily need to rely on multiple expansion or changing growth expectations to generate strong returns, as much of the value is created through the compounding of the underlying business itself. So let's see how we did. All right. So let me pause for a second. And that's kind of the setup. And my concern or frustration, maybe too big of a word, but what I worry about is got lots and lots of words, but we don't have a really crisp definition of what a compounder is. So I'm going to go back to first principles. My question is, how do stocks go up over time? And there are four ways a stock can go up over time. Very, very basic. I'm just going to do this basic. Grow NOPAT, grow the earnings with a constant PE ratio. So if earnings go up over time and the PE ratio holds, stock price will go up. Not that complicated. Grow your NOPAT and increase the PE ratio. I'm just giving you the four ways stocks can go up over time. And obviously, if a company grows its NOPAT and increases the PE, then the stock will go up. I have two forces pushing the stock higher. All right, keep NOPAT constant while the PE ratio increases. You'd think of this as being somewhat unusual. There's flat earnings growth or modest earnings growth, and the PE increases. You might ask, well, when does that happen? Well, Apple has done that for the last decade. They've grown earnings quite modestly, and their PE has expanded fairly dramatically. That's been the big driver of growth. I have done a couple of Apple webinars out there. You can go look at them if that's intriguing to you. And then the final one is really somewhat of an unusual one, and I'm not going to focus on it, but you increase the PE ratio significantly to offset a decline in NOPAT. This would be a case where a company's investing aggressively, hurting their profitability, but everyone's very excited about the other side after the investment's been made. Those come along every once in a while. Generally, the stock pauses until there's more evidence that the investment will pay off, but it is possible the stock could go up. All right. So here's just a quick table. Green means the stock goes up. Red, stock will go down. Yellow is neutral because you have offsetting forces. And what I want to focus on is these three. So your NOPAT stays constant over time and the PE expands. Your NOPAT grows over time and either the PE expands or stays constant. In those three cases, the stock will go up. So now we have to ask our question, beg the question of what drives PEs? And I know this has been a huge discussion for lots of years on Wall Street, but I want to give you just a very simple explanation. All right, so the first case was you grow your NOPAT earnings with a constant PE. So why do PEs stay constant over time? And the answer is that investor expectation for future NOPAT growth and incremental ROIC hold over time. Let's unpack that for a second. So your PE is a function of growth expectations and the duration of your return on invested capital. So for PE ratios to stay constant over time, expectation for NOPAT growth has to remain consistent over time, can't start to fade. And very important, and the business continues to be a good business. That incremental ROIC holds over time. It doesn't have to go up, but it can't go down. So if the growth rate starts to fade and or the incremental return on capital starts to fade, that PE will start to contract. It's that simple. So if we want to make the argument the PE is going to remain constant over time, then you're making the argument that that future NOPAT growth expectations for future NOPAT growth is holding. The company can continue to grow in the future like it has in the past. And the quality of the business is going to hold, meaning the incremental return on capital is going to hold over time in the future. Really important. All right, the other cases, other four cases, were all based on the PE ratios expanding. So if PEs are a function of expectation for NOPAT growth and expectations for return on invested capital, then by definition, PEs would increase or expand when expectation for NOPAT growth increases while the return on capital holds. So the quality of the business holds and the company's growth rate starts to increase, PEs will expand. Or expectations for NOPAT growth holds, they'll continue to grow at historical rates or whatever investors think. While the business gets better, the incremental return on capital increases, or obviously both. If growth picks up and the incremental return on capital, that return on capital of that incremental growth expands, the PE is going to expand almost by definition. So I'm going to walk you through kind of a quick visualization of this. So this is just a yearly NOPAT, nominal numbers, years 1 through 10. All right, we can split those future NOPAT into two components. The blue is what we'll call the steady state no growth. I refer to that as the earnings power value. And then the green is growth. And we need to think about valuing each of those. So let's walk through that. There's your earnings power value, and there's your market implied value of growth. Those are two components. So blue is your earnings power value. That's NOPAT capitalized, essentially. And green is your market implied value of growth. All right. So for the enterprise value to increase over time, you need, our first case, we're going to go with earnings power value increases over time. They grow their NOPAT. And the market implied value of growth increases over time, which effectively, by the way, is expanding their PE. So it's first case. So if we added those two together, obviously EPV plus market implied value of growth is going to increase enterprise value over time. So that's the case. So if they both increase, obviously the stock will grow. Okay, great. Here's your enterprise value goes up. But in this case, the earnings power value increases. Management's doing a great job of growing earnings. But the market implied value of growth is holding. So it's just constant. All right. We added those two together, obviously. BPV plus a stable market implied value of growth is stock will grow. All right. Third case, EV goes up. In this case, earnings power value is flat. As I said, this is Apple, very modest growth in its earnings power value over time. But the market implied value of growth increases over time. This is what's happened to Apple. If you add those two together, obviously, enterprise value will grow. Okay, great. The final case, I'm sorry, and that's the final case is the EV would go up with an expanding PE, and I'm not going to show that example. All right, so now all of a sudden, if we change from NOPAT and PE to earnings power value and market implied value growth, we get exactly the same setup. And that's why I would say that NOPAT and earnings power value are the same thing. One's just a multiple of the other. And your market implied value growth is effectively your PE. So rather than talk about PEs, I want to talk about market implied value growth and how to think through that green layer that we were talking about. All right, so it's really simple. If price is greater than value today, that means earnings power value greater than earnings. That means you're paying for growth, market implied value growth. That's the gap between P and V. And there are three things that can happen. Price can converge to value, price to value premium holds, or the price to value premium expands, which this is effectively what happens. On the very first case, you pay a premium for growth today, but that premium shrinks over time. So your market implied value growth approaches, your market implied value growth goes away. Your enterprise value approaches your earnings power value. Here's a case where your market implied value growth holds over time. So earnings, the relationship between enterprise value and earnings power value holds. And then here's the third case, which is the earnings power value to ratio expand. You have an expanding market implied value growth. So we can see on all three of these, we account for essentially all three of the possibilities. Market implied value growth shrinks, market implied value growth is constant, or market implied value growth expands. And so that exit market implied value of growth is critically important. What I said up front is everyone that talks about compounders talks about increasing intrinsic value over time, which is technically true. But if you focus just on earnings power value, which in all three of these cases, the earnings power value went up, that's the blue line. and ignore what happens with your market implied value growth, then your ultimate return is going to be very different in each of these cases. So in the first case, if price does converge to value, your market implied value growth goes away, then your annual return will be less than the growth rate. In the second case, if your price to value premium holds, then your annual return will equal your growth rate, which I think most people on compounders is kind of, they're assuming the middle chart. But it's really important to tease that out, which I want to do in the next couple of slides. All right, the final case, which I think is unusual, but your price to value premium expands and your annual return there would be greater than your growth rate. So this exit market implied value growth is critically important. We need to think through what drives that. I'm gonna go back a couple of slides just to get to this final, let me go back a bit. For the PE to remain constant over time, you have to keep your growth profile consistent and the return on capital has to be consistent. That's going to be the key insight, which I want to flesh out. All right. All right. So that's my definition of a compounder. Now that we've set that up, number one, ROIC is greater than the cost of capital. That's a non-negotiable. That's by definition. You cannot create shareholder value unless the return on capital is greater than the cost of capital. And that leads to a sustainable competitive advantage. The company needs a sustainable competitive advantage. I'm going to flesh that out in a minute. The incremental ROIC has to be greater than or equal to ROIC historically. So the economic quality of the business must be maintained. If the incremental return on invested capital starts to fade, green will not hold. Market implied value growth will not hold. And this, I will argue, is the real insight to the compound. ROIC and the incremental ROIC must be greater than the growth rate, the growth in invested capital, the growth rate of invested capital. The business must be self-sustaining. And that's a really important insight. So ROIC greater than the cost of capital, most people have. Incremental ROIC greater than equal to or greater than our ROIC historical is really important to maintaining that market implied value growth premium. And if it's greater than the growth rate, here's the key. That's where you create a lot of shareholder value. So that last piece I really want to add, very important. All right, number two, large expanding total available market. Yeah, we need a large organic growth opportunities, no question. The hardest part, I think, to analyze, but that's really important. And your incremental growth rate must be equal to or greater than the historical growth rate, which is really hard, but really important because you must maintain the company's growth profile, stable or expanding market implied value growth. So market implied value growth is going to be a function of growth and a function of return on capital. Your most important indicator on the margin is going to be incremental return on capital, incremental growth. If your return on capital is starting to fade, the whole notion of sustainable competitive advantage is being challenged. If your incremental growth rate starts to decline, decelerate, that's going to call into question the total available market. So those are the two most important metrics in my mind. Incremental return on invested capital, incremental growth rate. That's what are the way you want to both define and monitor your compounds. And then, of course, management. Management and the board understands the company's competitive advantage and stays focused on creating long-term shareholder value. They must maintain constant vigilance. And I would say this is really hard from the outside. And when Buffett talks about culture, and when Charlie Munger, we were talking about Costco, talks about culture, this is really what they're focused on, is a board, management and the board, that whole governance package understands the company's competitive advantage and stays focused on creating long-term shareholder value. And I've met so many CEOs and board members that don't get this piece, and they say it, but they don't understand what it means. And so these are my three. So I have boiled down all of those words that I like to refer to as that word sandwich down to three things: ROIC, large expanding market, and a focused management team. That for me is really it boils down to. And the metrics you want to look at is incremental return on capital, incremental growth rate, and then whether or not management is staying the course. That's the key. And I do want to walk through competitive advantage for a brief moment. And I have some lectures out there that you can go look at, but really important. So the three most powerful frameworks I like are Michael Porter's Competitive Advantage, Bruce Greenwald's Competition Demystified, and Harbaugh and Stewart's Willingness to Pay. I'm going to focus very quickly on the first two. So Michael Porter, Harvard Business School professor, published the book in 1998. The key here is it drawed on a long history of industrial organization, competitive strategy. It's very good. One of the most influential books on strategy. Created something he calls his five forces. I'm sure everybody on the phone, everybody on the call is aware of these. We walk through it. The key is a battle for profits. There's a certain profit pool in the market, and everybody is battling for it. And that's what you want to think about when you're doing a Porter analysis: is who has the upper hand to capture more profit over time. So if the suppliers to your company have bargaining power, they're going to raise their prices over time, which are going to result in higher costs for your company and lower profitability. On the other hand, if the buyers of the product have power, they're going to force the vendor to lower prices over time, and that's lower profitability. So in this case, the suppliers are trying to capture more of that profit pool. In this case, the buyers are trying to capture more of that profit. Threat of new entrants or substitutes, really, you lose customers, which lowers unit volume, lower revenue, and lowers profitability. Almost always lowers profitability because almost all these businesses have some aspect of scale. So if you lose the lower revenue, the fixed costs don't really change. You're going to lower the profitability. So in this case, you're just losing customers, losing revenue, losing profitability. So the question you really want to ask yourself in a Porter analysis: who has the most power in the profit pool, and where is that shifting over time? Is it suppliers or buyers, or is it the possibility of new entrants or substitute products? All right, that's a key. Want to ask: is the balance of power shifting? And then rivalry, because aggressive management teams can ruin great businesses. So that's your fifth one. Just watch for. And rivalry, in my mind, is often a function of low variable costs, low degree of differentiation between products, and management ego. I'm not really joking about the last one. It's management that is hell bent on gaining market share, and as they strive for more market share, they ruin the business for everybody. All right, competition demystified. Book was published in 2005. I think it's the one of the best books on strategy. I highly recommend it. Porter's is very important to know, but I think reading at least the first half of this book is critical. I really like this book. It drew on a course that Bruce developed at Columbia called The Economics of Strategic Behavior. And I want to walk through his model. So he has four components of competitive advantage: customer captivity, cost production advantage, which is supply side economies of scale, and then government involvement. I'm not going to address the last one. And for most people, Greenwald's model will seem too simple. Yet once you work with it, you appreciate the brilliance of its simplicity. This thing is simple and I think incredibly powerful. All right, so here's just a matrix to think through Bruce's model. All right, company has the ability to charge higher prices. I would almost call this price elasticity. The customers are insensitive to price. That's a demand side advantage. It's external facing. It looks like this. The red is the competitive market price for a product. It's really where demand intersects with the industry average cost curve. The company you're looking at has the ability to charge a price higher than that competitive market price. We call that a demand side advantage. So I went too quickly. And that's what you're looking for. And then you have to ask yourself questions of what's the source of that higher price, and how sustainable is that higher price? Supply side is essentially lower costs. It's external, it's internally facing, and it comes in really two ways: production advantage or a scale advantage. Distribution, I just want to single out. If a company owns the distribution, it's potentially a scale advantage. If they have access to the distribution, it's a production advantage. And the key here is you look at the industry average cost curve, and where that gets set is where demand equals the industry cost curve. And the company you're looking at has a lower cost, total average cost, and that's a supply side advantage. And in these cases, you want to understand the source of that competitive advantage, and you absolutely need to understand the sustainability of that competitive advantage. All right, last one is capital efficiency. This is a type of scale advantage. All right. So I want to define what a competitive advantage is, just in the same way I was trying to define a compound. So it's defined by the structural characteristics that other companies cannot replicate, at least well, and impede effective competitive attack. It's it's structural advantage. You're looking for companies with a structural advantage. Two, these characteristics must be unique to the company or shared with a couple of industry peers. And the companies must reinforce the moat, barriers to entry, and contain rivalry. I'm going to just say this point again, it requires a limited number of direct competitors, fewer than 4. So you need to limit the industries you're looking at to no more than 4 companies, including the company you're looking at. You're evaluating or invested in, whatever is the case. If you get more than 4 companies, the industry is going to be too fragmented. It's going to be very hard to maintain rivalry and control pricing. So we're really talking about oligopolies, potentially natural monopolies. Those are the best companies. And when we talk about Costco, we'll talk a little bit about that fact. This is also really important. It's almost impossible to create competitive advantages from scratch. They don't exist. So therefore, competitive advantages only accrue to incumbents and must be developed over time. And there's no such thing as a challenge or a competitive advantage. I hear this all the time from young companies, this is our competitive advantage. No, that's not a competitive advantage. What it is maybe a competitive edge, or at least you hope it's a competitive edge. Maybe it's a better value proposition, but it's not a competitive advantage. Until you're an established vendor, you don't have competitive advantage. All right, evidence of competitive advantage, consistent superior profitability over time. I think ROIC is the most important metric. Concentrated market share with a limited number of competitors. We just talked about that. So if you're looking at an industry and you have a lot of vendors there that greater than 5, I would argue that industry doesn't have competitive advantages. That the companies in that industry cannot develop and maintain competitive advantages. Too many vendors. Stable market share over time. This is one that's always a little perplexing to people, but market shares are much more stable than people realize, and that's a good thing because companies that have great businesses generally are industries where you have stable market share over time, which, by the way, as a corollary, means the companies cannot grow faster than their industry over time, by definition. Important to wrap your head around that. And then the final one is few new entrants and evidence of failed entry. When Amazon announced they were getting into the cell phone business with the Fire phone, and then 6 months later announced they're getting out of the business, that's generally a sign that that's a very well-established industry, stable market share, for what it's worth. And as I said, I just want to reemphasize this: companies cannot grow as fast as cannot grow faster than the industry. Can only grow as fast as the industry growth rate. So what's this leave us with? This is what I will refer to as my definition of sustainable competitive advantage. Customer captivity and either a proprietary production or service delivery processes or scale, and management's constant vigilance. That's it. There's my definition of sustainable competitive advantage. Customer captivity, and then you need one or the other. They rarely come together. Some sort of proprietary production or service delivery process or scale. The one on the left is really a lower variable cost. These are hard to sustain over time for lots of reasons. The one on the right is lower average cost. And then management's constant vigilance. That's it. Let me talk about management for a moment. This is from Tim Kohler's book on valuation, the McKinsey book. I just thought this was pretty good. Number one, it's crucial that managers and boards have a clear understanding of what value creation means. I have met few boards that pass that, but fine. The definition cannot be limited to simply maximizing today's share price. And there's lots of reasons why. Because of today's share price is earnings power value and essentially a market implied value growth. Management has great influence over earnings power value, but they have significantly less influence over market implied value growth. So if you have a management team that's really focused on trying to maximize the current share price, that means they have to be they have to be focused on maximizing the green market implied value growth, which means they are focused on convincing investors that they can grow fast and maintain their return on capital. And persuasive management teams might be able to do that over a short period of time, but over a longer period of time, truth will bear out. So what Kohler says, a better objective is maximizing the company's collective value to all of its stakeholders now and in the future. And there's a lot of work starting to come out that the best companies are ones that, guess what, effectively practice ESG without calling it ESG. They treat their suppliers well, they treat their customers well, they treat their employees well, and they have a lot of respect for the communities in which they operate. And so much of the criticism of shareholder-oriented capitalism is really a critique of companies' short-term behavior. I completely agree. All right, so here's my check. Management thinks long-term, understands the organization's competitive advantage. I'm somewhat frustrated on this one. They then make defending or extending the organization's competitive advantage a priority. I think this is the number one priority. And by my mind, this is the definition of strategy. They can articulate the company's culture and does so often. I would argue that to the point of people hate hearing it. And then as a result, just the management spends time making sure everyone in the organization understands their role in creating long-term shareholder value. This is my checklist, I think, and then develops for people. That's it. That's my checklist for management, particularly in long duration investment. Fine. All right, strategy. If you believe that is management, then strategy is pretty simple. Company needs to have a simple, clear, succinct, actionable strategy statement that every employee understands, can use it as a guiding light for making difficult decisions. Number two, the statement should include objective, which is a specific measurable goal the strategy is designed to achieve in a specific time frame. That's key. Scope, the part of the industry landscape in which the firm will operate. Advantages, what's the customer value proposition and how will it be delivered? And then boundary, specify where the business will not go and what the business will not do. I've seen very few of these in my career, but I would be excited to see them. But this, if you had this focus, this is what management said again and again and again and again. Pretty powerful. And then you need to over communicate it with the team and all employees because they just don't hear it the first time. Everyone says, oh, we posted it, we sent it out in an email. People didn't open it. That's the key. I think these two can be used as management checklist. We talked about that. All right, I do want to talk about something. It creates visuals to reinforce what I said. But I used to work at First Boston many, many, many years ago. I worked there with Michael Mollison, and during the time we worked together, we developed this concept called the competitive advantage period. Now, in fairness, Michael came up with the idea of competitive advantage period, and he and I we published a research report in January of 1997. As a side note, Michael updated his competitive advantage period report and published it, I dare say, 2 weeks ago, but in the last couple of weeks. Quite good. But this was the original report in 97. Now, the other thing I want to point out is I no longer worked at First Boston when this report was published. And in a true, I don't know, heroic, but an amazing gesture, Michael made sure my name and my email address at my new firm was on the report. I mean, it was really a stand-up thing to do. We had worked on it together, but he could have easily published without me, and he did not. All right, and what Michael's real idea of the competitive advantage period was to think through the duration of a company's competitive advantage. Or another way of thinking about it is the decay in a company's competitive advantage, and that results in a decay in excess returns. And that period of time is what he referred to as the competitive advantage period, the period of which the company has a competitive advantage, and that has stuck. It's a really great phrase. So we had a couple of charts, 3 charts in the report. One is the sort of theoretical decay that over time, because of competition, the return on capital would slowly approach the weighted average cost of capital. We then argued that the way the stock market works is that they would assume that those returns would fade for a while, and then they would just stop thinking about it, and then it would be effectively dropped to excess returns would drop to zero. That's kind of how stocks got priced. And then what we showed is that if, as time passes, if the original set of assumptions hold, this is really important insight, then that cap chart, those top 2, would move forward by 1 year. And that shaded area would effectively be the excess returns. That's how compounders go up over time. Is there is a fade effectively implied, that's what we argued in 97, fade effectively implied in the valuation. As time goes on, investors realize that that fade was either too aggressive, or the estimate of the competitive advantage was too short, or just it was time to give the company the same set of assumptions that they did before. and that you pick up that extra area, the shaded area. And this, I think, is a great way to think about it. Now, I'm going to do is I've been working on this separately from Michael for the last, I dare, 30 years. That's right. And he's spending a lot of time on duration. I'm spending a lot of time on growth. All right, so here's something that's kind of fun. This is a reverse DCF. This visual is a reverse DCF. This is that there's your DCF formula. The value of the company is equal to the present value of NOPAT, discounted back for time and uncertainty from now until forever. And what I have built is a 5-stage growth model, 5 different stages, 25-year forecast, no terminal value. That's why at the end, the cash flows drop. What I have in the blue bars in the chart is the present value slices from each of those years. So if you look at year 6, that's the present value of year 6 free cash flow or NOPAT. You look at 14, that's the present value of year 14 cash flow. And if you look at year 25, it's almost zero, but that's the present value of year 25 cash flow. And so the area under the curve is the summation of all of those. So that is the enterprise value. It's a reverse DCF, effectively. It's a visual DCF. And that's your enterprise value. And the way you want to think about it is the first part of the chart where it expands, that is because growth is greater than the discount rate. The second period is growth is equal to the discount rate. Third period is of the 5-stage model, growth is less than the discount rate. And then we have growth is zero, and then hyperbolic discounting, which I'm not going to go into detail on this. But that's your chart. If you look at the chart before, effectively does that. So the challenges of a reverse DCF are 3 unknowns and 1 equation. So it's magnitude, duration, growth is we're solving for. And I've effectively done a 25-year forecast with no terminal value. That's how I get around it. And this little graphic, the curve, the black curve, is what I call the growth profile. And that's just kind of a phrase that the opportunity set is can be thought of as kind of a growth profile. And it's a return on capital or a positive spread and growth. So now if we just take this, we move forward in time, as time increases, the enterprise value goes up. This is similar to the charts that Michael and I published in 97, just a little bit more refined. So if you go forward in 1 year and the growth profile holds, guess what? We pick up all of that increase in value. The dark blue is what you picked up as an increase. If you go forward 2 years, it's literally the same. If you go forward 3 years, now you're going to see the same. So the return is effectively your free cash yield plus growth if you assume a constant PE. Now, a constant PE is a stable incremental growth plus consistent incremental return on invested capital. Another way of thinking about it is your market implied value growth holds. So now we can show another way of the visualizations. Why do these compounders go up over time? Because effectively there's an embedded fade between growth and return on capital. And so if the incremental return on capital holds, that satisfies Mobison's criteria. And if the incremental growth rate holds, that satisfies Johnson's criteria. And guess what? You end up with a constant PE or a constant market implied value growth. Stock goes up over time. All right, so here's a simple way of thinking it. So your market implied value growth is a function of growth, duration of that growth, and the spread between ROIC and minus your cost of capital. In my model, I just hold the duration at 25 years and set WACC at 10%. You can do whatever you want. Then your market implied value growth just becomes a function of growth and your return on invested capital. And guess what? Changes in your market implied value growth, changes in growth, changes in return on capital. So we're right back to where we were earlier, where the key to compounders is the incremental growth and the incremental return on capital. Don't worry about the 25-year duration. You can set that to anything you want. Don't worry about the WACC. You could use whatever you want. The result is essentially the same. That the change in green, the change in the PE, these are all the same thing. Effectively is the change in growth, perception of growth, and change in return on invested capital. So market implied value of growth is investors' expectation for future growth. And that's going to be a function of that incremental growth rate. If growth rate fades, guess what? Market implied value growth is going to start to shrink. If the incremental return on capital starts to decline, people call into question the quality of the business, and that green, that market implied value growth, is going to start to contract. Your PE is going to start to contract. Same thing. So now, what about valuation? We've not talked about valuation at all. Let me give you a little formula that works pretty well. So the implied return if you own a stock is equal to its free cash flow yield, which is your free cash flow divided by enterprise value, plus your NOPAT growth. Now we're assuming a constant PE or constant market value of growth. So I have to assume. All right. Now we know that free cash flow is NOPAT minus growth capital. So free cash flow is NOPAT minus growth times invested capital, assuming the return on capital is holding, right? If your return on capital is expanding, then that growth, the amount of incremental invested capital you have is lower than the growth rate, NOPAT growth rate. If your incremental return on capital is fading, then guess what? The amount of invested capital you have to, the amount of invested capital you need to add to your growth is going to be greater than your NOPAT growth. All right, so we know NOPAT is equal to ROIC times invested capital. Therefore, we combine all of that. Free cash flow is your ROIC times invested capital. That's NOPAT minus growth times invested capital. Combine them. And so your free cash flow is, future free cash flow is essentially your return on capital minus growth times the invested capital. So this is where we're, once again, we come back to the incremental return capital and the incremental growth rate. Comes right back to it. So that's the key insight. And then here's the takeaway. If your return on invested capital is greater than your growth rate, then the implied return will be greater than growth. So you get the added benefit of those excess cash flows, the unnecessary distributable cash flow. If your return on invested equals your growth rate, then your implied growth for the stock is just going to be growth. And if your ROIC is less than your growth rate, guess what? Your implied returns will be less than your growth rate. So we're really focused on the top two. Once again, as I said, market value growth only holds when your ROIC is constant, your growth rates are constant. All right. I'm gonna take a sip of water. Been talking nonstop. Now, by no means is this a recommendation on Costco, and by no means am I an expert on Costco, but I just want to use Costco and look at it through these filters. There's the stock, been a monster stock. Anybody that's owned it, monster stock. Earnings power, I'm sorry, the enterprise value has increased by almost 22% in the last 11 years. Amazing. That's pretty good. All right, I'm going to split the enterprise value into earnings power value, blue, market value growth, green. You can just see, pretty interesting. So your compounded average growth rate for the enterprise value has been 13.4% over 11 years. That's pretty amazing. They've grown earnings power value by 13%. Pretty amazing. So earnings power value obviously is a function of the growth and the duration of the ROIC minus cost of capital spread. That's very good. And your implied return, as we talked about, is your free cash flow yield plus your NOPAT growth rate. There's Costco's free cash flow yield over the last 10 years, just so you can see it annually. So in 2015, if you were buying the stock, the implied return was a 1.9% free cash flow yield plus, and then what I plugged in was the actual forward 10-year growth rate of NOPAT, 13.4%. So your return should have been 15.3%. What was your return? 21%. All right, if we look today, the implied return right now is about 1.8%. And I just put in 13% because that's actually been the average growth rate for NOPAT over the last 5 years. So when you look at Costco, if PE holds, there's an implied return of 15%. Pretty amazing. So now you have to figure out, is the 13% a good number or not? That's the key. But what about that second piece, right? This is earnings power value. What about market value growth? This is Costco's historical market value growth. This is with both of them. There's the market value growth by itself. I've taken out earnings power value. Compounded average growth rate has been 25.5%. So the underlying business has grown at 13.4%. But the green, that's market implied value, that's your expectations. That's grown at 25%. The reason the stock's been able to grow at 22% over that last 10, 11 years by more than the underlying growth rate is because the market implied value growth has expanded. So earnings power value, the compounded average growth rate for the earnings power value has been 22%. Earnings power value has grown at 13.5. Market value growth has grown at 25.5. So growth in EPV is about a third of the return. Two-thirds of the return is expanding market play value growth. Do not underestimate the role of green in thinking about this. That terminal green is critical. They gave a lecture last week on private equity. They have the same problem. It's not publicly traded, but when they buy a company, they're buying earnings power value and they're buying a certain market implied value of growth. The exit valuation they're going to get is whatever that exit earnings power value is, and whatever they can convince the next buyer is the appropriate level of your market implied value of growth. And in Costco, it's two-thirds of the return, two-thirds of the return. So at the very beginning of this presentation, I said, everyone seems to think the way you define a compounder is they grow intrinsic value over time. If you define intrinsic value as enterprise value, then you're missing a huge component, which is what is that incremental investor going to pay for green? What is that investor that you're selling to going to pay for their growth expectations going forward? In Costco, if you bought this 10 years ago, the implied return was 15%. You actually got 21%. That extra 7 points, 6 points, was because the PE expanded. The market implied value of growth expanded. Really important to understand. So, what are Costco's competitive advantages? Customer captivity, extremely happy customers, habit, and probably some sunk costs with the membership. What is their proprietary production service delivery process? Technically nothing, but boy, execution's been pretty spectacular. There's a management team that gets it. They're incredibly focused and they communicate that to the employees every day. So give them an A plus on that. Yes, they have scale and management execution. Terrific. I'm going to just quickly touch on 3 quotes from Charlie Munger. Probably nobody was closer to Costco on the outside than Charlie. In 2019, he said, I saw on the Costco board for 25 years, or I was on the, in all that time, I never saw Jim Sinegal, he was the CEO, make a single decision that sacrificed the long-term health of the business for a short-term gain. Not one. That is extraordinarily rare. Most CEOs, even good ones, occasionally compromise. Sinegal never did. He then went on to say, also at the same meeting, what I look for is a business with high return on capital, right? We all get that. The ability to reinvest at those returns. Yeah, we touched on that. And a management team that won't squander it. So Charlie obviously understood. Costco has all 3. The returns on capital are structural. They have a structural competitive advantage. They come from the membership model and the purchasing power. That's scale and a little bit of switching. The reinvestment opportunity is entirely underpenetrated. It's an underpenetrated world, right? So there he says the TAM is huge. And Senegal would no sooner raise prices inappropriate than he would steal from a widow. I think it's really important because a lot of the definitions of these commenters have pricing power. You could argue Costco has pricing power, but they never exercise it. Amazon AWS, they lower prices every year for the same capability. So I wouldn't get too caught up on that. I think what you want to think about is willingness to pay. But more importantly is the customers are not making their decision based on price. They're happy customers, not because of price, but because of the value they get from the product or service. And then he went on in that same meeting and he said, I've tried, this is really the sustainability of the business model. I've tried over many years to think of a business that would do to Costco what Amazon has done to other retailers. I cannot. The in-store experience, the treasure hunt, the fresh food, the sample tables, and the scale of the merchandise is not something you can replicate on the screen. I think that's true, but I think there's also a tribe membership that's also there. The membership creates a psychological bond. That feeling is not available for sale on the internet. So he was coming at Charlie, brilliant, brilliant. He was coming at the same thing with the same structure that I proposed. All right, there is Costco's return on invested capital over time. It's expanded as they've gotten bigger. There's their incremental ROIC. You can see it's always been, effectively always been above their return on invested capital. That's a criteria, very good criteria. And then there is your market implied value growth. That's green as a percent of enterprise value versus the return on invested capital. And what you've seen over time is the market implied value of NOPAT growth has expanded as the return on capital has expanded. So here's some evidence that those two seem to be linked, if not at least directly driven that way. All right, there is Costco's chart again, monster stock. But do keep in mind the role that market implied value growth has played in that return. Blue has been incredibly steady, 13% for 11 years is spectacular, particularly at their size. But 2/3 of the return has been the expansion of the market implied value. That's very important. All right, finally, coming back to it, my definition, you're looking for return on invested capital greater than the cost of capital. That's a non-negotiable. Your metric incrementally is your incremental return on invested capital versus your historical return on capital. And the best companies, their return on capital and incremental return on capital are greater than the growth rate. Number two, large expanding total available market. It's hard to know ahead of time, but your incremental growth rate has to be equal to or greater than your historical growth rate. The moment growth starts to fade, you call into question how big the TAM is. And then third, management and the board understand the company's competitive advantages and stays focused on creating long-term shareholder value. That's my definition of a compounder. It's tight, it's simple, it's operational, and I give it to you. All right, and then this, just coming back to it, if your ROIC is greater than your growth rate, your return is going to be greater than growth. All right, and I made it in less than 1 hour. 145 slides, 55 minutes. Normal pace for me.
There's a great and speedy overview of the kinds of long duration investment frameworks that you can encounter in the Wharton Applied Value Investing Certificate Program. Moving over to the Q&A section, we had a few come through during the presentation. The first question, and this is some interesting food for thought. The question goes, can an energy company in the exploration and production segment be a compounder? Kind of interesting, given the cyclicality of the underlying. Have you thought about this question?
Yeah, I've thought about it, and let me just say up front, what I know about energy my grandfather had a great phrase. I'm going to quote it. He used to say about somebody who knew nothing. He said, that guy knows about energy. Me know about energy. You could put in a thimble and have room for a cup of coffee. So just I was like, I know very little about energy. I do know one thing. It's highly dependent on the price of the commodity. And given I don't know whether it's cyclical or just something, it's a function of supply and demand. Those things move around. I would be surprised if they could. I would be skeptical they could, but that's sort of the extent of my knowledge.
Got it. And then this is another interesting one. How do you consider the point that higher growth rates will attract additional supply and depress returns?
Yeah, I think that's a really important thing to remember. And one of the things when I do a 4-hour lecture, 2-hour lecture on competitive advantage, we get into it. And one of the things I often say to the students is high growth good or bad for competitive advantage? The only time it's good is if you're scale. If it's a scale business with the likely outcome, winner take most, winner take all, growth is quite good. If it's a business where scale is potentially an advantage, but you could have multiple people that reach scale, high growth is bad. Because the one thing we do know about high growth, the way you get that is incremental customers. Customers have no captivity, they have no loyalty. And therefore, they're going to be fair game to everybody. So high growth is something that concerns me. Now, there is a subsegment of all this called hyper growth. And that's when an industry accelerates, a brand new industry starts or an industry accelerates. And once again, the higher the growth, the more vendors you can support. If it's got a winner take most, winner take all scale structure to it, then it's going to be first mover to scale, not first mover advantage, first mover to scale, and then they can consolidate it. But I'd be careful about really high growth. That would concern me.
It's a great one. The maybe as a follow-up on that one, here we are. One just came through. How does capital allocation influence value compounders?
Well, I would say it's critical, and you've got sort of two things to think about, kind of the decision process they're doing. But the only test of capital allocation is that what does it do to ultimately a return on capital? Now, what Michael Mauboussin has is he kind of says there's 5 things you can do in capital allocation. One is invest in business, one is M&A, one is pay down debt, one is R&D, one is buy back stock or pay a dividend. Now, buying back stock, I'm quite fascinated by this. You can use that little formula that I gave you, that when management buys back stock, what are they getting? The implied return is simply current cash yield, that free cash yield, distributable cash yield, plus what they can grow earnings power value at over time. And so if that is higher than the cost of capital, they will create value by buying shares back. When Apple started buying shares back in 2015, The implied return was about 11%, which is pretty amazing. I think higher than their cost of capital. Today, that's down to about 5%. It's the implied return. They keep buying back stock. I would argue they're effectively destroying shareholder value. Longer conversation. So capital allocation is really important. Acquisitions, really tough to pull them off. There are some examples of compounders that have consolidated markets. But what you want to think about is acquisition. Number one, you can't overpay. Number two is it's got to enhance the competitive advantage. Two primary sources of competitive advantage: happy customers, and then scale. So when you look at the really great roll-ups, what have they done? They've done an amazing job of increasing their scale. They've executed. Constellation did an amazing job of managing independent software companies. Downa here has been an amazing job of integrating acquisitions. But they're hard to pull off. It's harder on the customer side. Generally, you're not benefiting your customers. So think scale. The roll-ups, think scale. Don't overpay and think scale. This idea that it's just mathematically, I buy at 5 and I'm going to get traded at 10 times. That arbitrage doesn't last very long unless the quality of the business holds up.
That's a very good point. We had two separate questions that are actually effectively the same thing. The question goes, can a REIT be a compounder, or would this compounder framework apply more or less to real estate compared to a business such as Costco?
The answer is, I'm not going to talk about the REIT structure, but let me talk about real estate underlying the REIT structure. And the answer is, yeah, I can, sure. In fact, every year I always have students that are in real estate, and they're always marvel. They're always like, hey, wait a minute. This is how I should think about real estate. I said, yes, you should. And the growth is often growth in rents, which they like. And then they can modify it. I've had several people take my course at Columbia, go back to their real estate job, apply it, and use the model in that way. So absolutely can apply to real estate. REITs are, the structures are different, but basically they're paying out a lot of the cash flow. So they don't have a lot of growth capital, but think through that piece. Not that hard to figure out.
We just got a huge slug of questions. We may need to lightning round some of these. The first question goes, can you think of any company traded on a European stock exchange that is widely considered a compounder?
This I can do a lightning round, because you can stop the sentence. Can you think of any European company listed? And the answer is no, because I only focus on America.
All right, here's one. It goes, Paul, quick question on applying your compounder framework to tobacco companies. Historically, the major players have generated ROIC well above their cost of capital, but the traditional cigarette TAM has been structurally declining. With the pivot into reduced risk products like e-cigarettes, heated tobacco, and nicotine pouches, do you think tobacco companies could now qualify as compounders under your definition, particularly the large and expanding TAM criterion?
Yeah, I think, I just use the criteria, because what they're doing is pivoting to, tobacco, I think it's a disgusting product, but it is a spectacular product because it has the ultimate in switching costs, addiction, legalized addiction. The other thing tobacco companies do an amazing job is become essentially sources of taxes for many municipalities. So they're never going to go out of business because they got to keep the tax revenue coming in. So that's kind of cool. I like that. And then the new products are similar in that they are addictive, and so high switching costs, and tend to have very high return on capital because the barriers to entry and things like that. So yeah, I think conceptually they were. You got to look at the growth rate, but yeah, remember your return is the cash yield plus growth. So if they can accelerate the growth through new products, yeah, why not?
All right, next question goes, to look for companies that have 4 or fewer competitors, wouldn't that limit the scope of businesses that you could invest in the world? Or rather, you could create a list of those companies throughout the world and wait until you have a price at which you'd want to invest.
Excellent. A+ on the exam. Yeah, no, that's exactly right. Yeah. It's a really important criteria, by the way.
Housekeeping question, is the G in the definition given for return on invested capital being above G, does that correspond to the definition in your lectures for long-term NOPAT growth?
Yeah, essentially it's the same. I use it a little loosely. What you're getting is growth in NOPAT. What they're investing is growth in invested capital. But if the return on capital holds, then those two numbers will be basically the same.
Here's an interesting one. Can SpaceX be compared to a super early stage of compounders? Just thinking forward without historical data. Would be interested in Paul's view on that. Great presentation. Thanks.
Yeah, I would use a slightly different. I use what the hypergrowth model that I've developed came out of the work Jeff Moore did with Crossing the Chasm. Um, you've got a couple of problems there. I think of SpaceX similar to I think of Pixar. I don't know if anyone remembers Pixar. Hit driven. Pixar was amazing movies, but what you had to, it was very dependent on the next hit, and SpaceX to some degree is going to be dependent on the next launch. So it's very much a project driven business. Maybe we get to this continuous growth that we're just sending up rockets all the time. Maybe, but it's so early on. I would go use the stuff I've done on hypergrowth. It's out there on the internet, just Paul Johnson hypergrowth, or value of growth. I have a whole lecture series. I think that's probably a better model, related but better model.
Great. Here's an interesting one. How would this inform a shorting strategy? Would you short companies that are not compounders?
I think last time I checked, Andrew, you could probably confirm this, that shorting's been outlawed. That it's become really hard.
There's a tacit agreement. No.
Yeah,
Not
shorting is
investment advice,
effectively, yeah, it's like a
suggestion.
levered long, reverse levered long. So it's not just the opposite of long duration investing, because there's no such thing as long duration shorting. I mean, it's really hard to implement. And therefore, because it's a levered long, inverted levered long, time becomes really important. Markets become incredibly upward biased. I don't know. Maybe it comes back. I loved it when I was a younger analyst. Shorting was so much fun.
I mean, one could make a case that the types of behaviors that disqualify, the types of management discretion and decisions that disqualify a company from being a compounder may from time to time present scenarios that yield, changes in expectations, loss of competitive advantage, or, let's say blunderous capital allocation, or, M&A that's wrong, or, that has a sour market reaction. You could say that, but going off of kind of the dogmatic definition of a compounder and expecting companies that don't fall into the bucket of compounders to be shorts relative to compounders can be pretty risky.
This is why I like doing these events with Andrew. That was an excellent answer. Thank you.
Just in order to short non-compounders, you need all other market participants to be aware of compounders and exhibit the same preferences.
At the same time.
Yeah, let me know when that happens. Here's a question. It's also kind of SpaceX related. How do you think about market size and competitive advantage in general in the space sector?
The competitive advantage sounds like it's pretty high. They've invested a lot. Blue Origin doesn't look like they're on the same technology curve. For that, I'd probably just quick pass, probably give them pretty high marks, but barriers to enter incredibly high. It's a scale business. That's good. You love scale businesses, particularly companies that get there. It's the market demand that I haven't looked at it, so I haven't spent a lot of time, but I would focus a lot of time on market demand. What does that really look like over time? I'm sure on the roadshow they're going to say it's big, but your job as an analyst is to verify.
Yeah. Your job is to corroborate or falsify that statement. All right. So the independently corroborate. So last question that I see in the mailbag here is, in your 25-year competitive advantage period chart, did you find one range of periods to matter the most? Like, i.e., I tried to eyeball where about 40% of the cumulative value could be attributed to. Was it the first 3 years, year 3 to 7, and so on?
Boy, I love that question. I've never had that question before. Although, given history, I've never shied away from a question I've never had before either. Well, I think I'm going to give a two-part answer. Tomorrow, right now, watch it, and I would say that 5 to 7. You really want to think through. They're kind of got a nice product cycle. They're executing well. Management kind of gets it, but 3, 4, 5 years out, what's that start to look like? Disruption. Management they're older. They get distracted. They get less committed. So I love the question. I would say 5 to 7. Kind of think more of a thought exercise. You're not going to be able to prove or disprove, but thought exercise.
Great. It looks like that ties off the question bag that we have for today's webinar. If you like this kind of back and forth, the answering of questions, it's a fun time every Wednesday. Paul and I and some of the Wharton instructors join up for our weekly office hours. It's loads of fun. We chat through these things. We chat through current things we're seeing. We're there for clarifications like these. Just as a reminder, the enrollment deadline for the Wharton Applied Value Investing Certificate Program is June 8th. It's an 8-week program. It's loads of fun, and it's a great way to kind of kick the tires on some of these frameworks as you work your way through the material. Paul, have I missed anything?
No, great. You did a great job. We'd love to have people. Andrew and I have a lot of fun Wednesdays from 5 to 6. We do this sort of thing without the slides.
Yeah.
All right. I want to thank everybody for their time. If you feedback, we love feedback. If you disagree, that's always valuable because then I can get better. But otherwise, thanks you. And Andrew, always a pleasure to work with you. Thanks.
Likewise. Hope to see everybody in the forthcoming cohort. Have a great rest of your day. Bye-bye.